George Leung, senior advisor to Hang Seng Bank, says the tariff war may prevent the mainland and Hong Kong from meeting this year's economic growth forecasts of 5% and 2% respectively. With that, Leung thinks the mainland should further open up its market and boost domestic demand over the long term. And Hong Kong can also benefit from such moves. Over the past weeks, all eyes have been on the escalating tariff war. Appearing on the TVB news program, George Leung, a senior advisor to Hang Seng Bank and formerly chief executive officer of the Hong Kong General Chamber of Commerce, said the tariff spats won't last too long. Leung said China and the U.S. depend much on each other over many aspects. And under the tariff war, the U.S. will soon face high inflation rates and a broken supply chain, while Chinese enterprises, especially small and medium-sized ones, will also be hit hard, putting both sides under great pressure to solve the problem as soon as possible. He believes that Washington's strategy of mobilizing other countries to contain China may not succeed, but the economic growth of the mainland and Hong Kong this year may not meet original expectations. Leung said whether China can maintain its 5% growth target remains a question, but Beijing should have multiple measures in its toolbox to buoy the economy. He predicts if the tariff war continues, with the levies being raised to more than 10 to 20%, the impact on Hong Kong's economy throughout the year will be relatively large. Leung said the domestic market of the U.S. had played an important role in America's ascension on the global stage in the past, as many export-led economies hold the greenback as assets. That's why Leung said the mainland should further open up its market and boost domestic demand to woo more allies in trade. While he noted some of these allies may not boast large enough domestic demand or markets to offset the loss from the U.S. market, such policy directions are necessary to counter the repercussions from trade wars.